You know, the federal estate tax is one of the most misunderstood income taxes or asset taxes in the United States. Hi, Bob Jennings here. Let's try to understand the estate tax with just a simple overview. Let's start by making sure that you're clear. Every state has a different rule than the federal government. I can't talk about state rules because some states don't even have an estate tax. Let's talk about the federal rules. For the year 2009, if your rich Uncle Harry dies, and rich Uncle Harry's got $3 million and leaves it all to you, is there an estate tax? What does this mean? Well, an estate tax is paid not by the person who gets the money, it's by the dead guy. How can Uncle Harry pay an estate tax? Well, here's what happens. When Uncle Harry dies, he is required, or his executor is required to open an estate with the local court. If there is more than $3.5 million, that's the federal number. If there is more than $3.5 million in the net taxable estate, then rich Uncle Harry's estate is going to pay tax. If there is less than $3.5 million, and rich Uncle Harry didn't have $3.5 million, remember the example we started with, if there is less than $3.5 million, there is no federal estate tax. Don't get confused. There still may be a state-level tax, a state of Alabama, Wyoming, Ohio, whatever, but at the federal level, $3.5 million is the threshold. If you die with $3,499,999, no federal estate tax. You pop up a dollar, sorry, you got an issue. All right, so how does this work? The way the estate tax works is we determine the fair market value of everything owned by the deceased on the day that he or she dies. Not what it cost, what it's worth on the day that he or she dies. The fair market value of all of those things, stocks, bonds, cars, homes, investments, retirement accounts, insurance policies owned by the dead guy, insurance policies payable to the dead guy's estate. Literally everything we own, we add up. We then subtract from that everything that the dead guy owed when he died. Home mortgages, car loans, any debt that is a valid debt on the date of death gets subtracted from all of those assets. We also subtract out any state death or inheritance taxes that are due. We subtract out any charitable contributions. We subtract out any funeral expenses. And when we're all done subtracting everything out, if we're still above $3.5 million, we'll have a federal estate tax. The federal estate tax is the highest income tax rate that we have in the United States right now. It approaches 50%. It's about 45% right now. So this is a very tough thing. And the federal estate tax is due 9 months after the date of death. Did you notice anything? It took 9 months to come into the world. It takes 9 months to go out of the world because you got to pay that estate tax 9 months after the date of death. If the estate is an estate that's not liquid, what do you mean? Maybe all of the assets are tied up in real estate or a business investment or something like that. You can possibly get an extension. Some common estate planning techniques, some simple ones you need to call the expert are, take advantage of the annual gifting program. Now, I discussed the gifting in one of our other videos, but you're allowed to reduce your estate by giving away, tax-free, up to $13,000 per person per year. All right, the second thing that you may want to consider, and don't do this until you talk to your advisors, the second thing you may want to consider is to name a beneficiary of your IRA who is not your spouse. Your tax professional will discuss that one with you, your investment advisor. But by naming someone other than your spouse as your beneficiary, we get some wonderful benefits of splitting this $3.5 million, basically doubling it up. Third thing that we often do is we want life insurance on the life of the dead guy to cover the liquidity. However, I want that insurance owned by someone other than the dead guy and payable to someone other than the dead guy. Let's say I'm the one that's going to die. I would prefer that my insurance be owned by my wife, payable to my wife, assuming I've been married for a long time. I've been married so long, I'm kind of scared to go home and eat. I've got so much insurance sometimes. Well, that's just one of many, many, many estate planning techniques. So let's summarize it here. If you've got less than $3.5 million after debts, after charity, after state tax, and after your funeral, you won't have a federal estate tax. You got more than that, it's a nasty tax. You need to get into your professionals right now. I've seen too many people who don't get this done. For further information, please call the number at the bottom of your screen or visit us at our website. Bob Jennings, thanking you again for listening.